Hey everyone, welcome to Money Wire Work. Today we're going to talk about how to successfully trade using what is arguably the most popular indicator in all of trading, the simple moving average. I'm also going to discuss a very valuable tip to keep in mind when trading the market at the end of this video, so stick around at the end for that. So what is the simple moving average? How do traders use it? And why is it so popular among those who trade the market? The simple moving average, referred to as an SMA line, is an indicator designed to filter out price action noise, identify trends, and confirm momentum reversals. When the price action is above the simple moving average, the stock is considered to be in an uptrend. When the price action is below the SMA line, the stock is considered to be in a downtrend. Traders consider the price action to be a continuation of either an uptrend or a downtrend until the price action breaks through the SMA line. When this occurs, traders reassess their current sentiment and adjust accordingly. While knowing the detailed ins and outs of how a particular indicator is calculated is not necessary in order to successfully implement into a trading strategy, having a basic understanding of what information the indicator is giving you allows you to have a more accurate understanding of how it relates to the price action. So with that in mind, how is a simple moving average calculated? A simple moving average is calculated by plotting the average price of a particular time period and then overlaying it on top of the price action. So if a trader has a period 5 SMA line and the last 5 candlesticks of a particular ticker was 10, 20, 30, 40, and 50, then the SMA line would be plotted at the sum of those numbers divided by 5. In this instance, the SMA line would be plotted at the $30 mark. If the next candlestick closes at 60, for example, the $10 candlestick close would drop off and the new SMA point would be plotted at 40, which again is the sum of the last 5 candlestick closes divided by 5. With this in mind, you can see how a line forms over time and how it relates to the price action's momentum. This is similar to how an exponential moving average or EMA line is calculated. However, the difference is that the EMA line weighs recent price action more heavily, while the SMA line treats all plot points within its time period as equal. An EMA line provides traders a more accurate indication of price action, but the downside is a slightly more choppy indicator that usually provides more false entries and exit signals than the SMA line. An SMA line may provide smooth and clear momentum indications, but entry and exit signals are typically slower when compared to the EMA line. Therefore, the trade-offs to using both and the success of these indicators largely relies on the trader and the strategy he or she is using. So how do traders use a simple moving average? As previously stated, traders consider the price action to be in an uptrend when it is above the SMA line and consider it to be in a downtrend when it is below the SMA line. However, one frequent hurdle traders must overcome when using the SMA line in this way is that not every instance where the price action dips below the SMA line results in a long-term trend reversal. This is because any period of time worth using as a setting has to be somewhat relatively close to the price action in order for the indicator to be relevant. A 500-day SMA line plotted on the S&P 500, for example, is collecting data from 500 days ago and treating it with equal weight as the most recent candlestick close. Therefore, the SMA line is going to be so far away from the current price action that the SMA line is going to be virtually irrelevant. Maybe not as irrelevant as Smashmouth in 2022, but irrelevant nonetheless. A 50-day SMA line plotted on the S&P 500, however, is only collecting data from as recent as 50 days ago, and therefore is much more relevant to the current price action. Maybe not as relevant as a Stranger Things costume at a 2022 Halloween party, but relevant nonetheless. We love you, Eddie Munson. The result of the simple moving average being closer to the price action is that the price action may frequently cross above or below the SMA line before reversing and continuing its current trend. Rather than viewing this as an obstacle, this characteristic can actually be viewed as a tool to enter a position by treating it as a good entry into a current trend, much like hopping on a moving train as it momentarily slows around a corner. Being able to spot the these momentary slowdowns, commonly referred to as healthy dips or breathers, and accurately separating them from trend reversals is one factor that separates successful, profitable traders from inconsistent traders. Collecting data using the 50-period SMA line on the S&P 500 weekly chart from 2010 to 2020, you can see the difference in success from a trader who views every dip below the SMA line as a signal to exit versus a trader who waits for the SMA line to start acting as a resistance level before exiting their trade. The trader who views these dips as healthy breathers has less higher quality trades than the trader who consistently gets out of a trade at every cross below the line. They also have clearer and more defined opportunities to add to their position or scale in. As a result, they can grow their trading account more consistently and have less stress in the process. So how do traders determine when the SMA line changes sentiment? If a trader is long on a stock, they can look for two key indications. One, the price action moves towards the SMA line and completely falls through before creating a new lower high and dipping back down to a lower low. Or two, the price falls toward the SMA line, bounces to create a new lower high, and then falls straight through to a new lower low. In both instances, the price action is visually displaying to the trader that the SMA line is no longer acting as a floor, but is now rather acting as a ceiling. A trader should change his or her sentiment based on this criteria and should treat the momentum as a downward trend until the SMA line begins to act as a floor once again. Another way traders can determine momentum shifts is by using the SMA line in conjunction with other indicators. If you haven't checked out my relative strength index video explaining how traders can successfully use the RSI with the SMA line, then I highly suggest you watch it after this, as it gives you insight into how the SMA line can be used with the RSI to massively grow your trading account. I also provide great detail on how you can use these two indicators with the MACD. Both the MACD and the RSI are momentum oscillators. Momentum oscillators, in my opinion, are a necessary component to the SMA line. This is because oscillators help traders visually see how a dip below the SMA line relates to the level of strength or exhaustion of a particular stock's momentum. For example, a dip below the SMA line when the RSI just crossed the 30 line should be treated differently than a dip below the SMA line when the RSI is near or above the 70 line. Even after adding other indicators and giving traders more to look at, the simple moving average is still an easy and effective way to trade the market. This is a large factor that contributes to the indicator's popularity. On top of that, the common understanding that a very significant portion of other traders use some form of simple moving average only reinforces the masses that they too should trade with that indicator. So in a way, it becomes a self-fulfilling prophecy that continually reinforces itself throughout time. This leads to my final point, which is that as much as we like to think we're trading colorful candles on a chart, we're actually not. As traders, we're trading human psychology and sentiment. And these indicators help us navigate through the complicated elements of the human mind. What this means is that while we know how humans think, we must act differently than everyone else when trading. That is, not everyone can buy low and sell high. A successful trader is one who always considers overall market sentiment and acts quicker than everyone else. For some, their strategy is to literally act different than the rest of the market 100% of the time, and many people have success doing this. So as you're trading the market, remember these key points, as it'll help you gain an edge over everyone else. If you like this content and wish to see more, please like, subscribe, comment, and hit the notification bell so you get notifications of all my latest uploads. And as stated earlier, I highly suggest you watch my deep dive analysis into the RSI, as it'll help you continue to grow as a trader. Until then, thanks for watching.